Welcome back to Invested, everyone. Another question on environmental issues on retail strip mall. Buying a strip mall with the former dry cleaners found minor contamination during phase 2. Phase 3 inspection cleared it. Problem. Strip mall had elevated levels of PCE and soil vapor during phase 2. That might go over a lot of people's head. If you know about it, that's great. Seller paid for another inspection to do more soil and air sampling. Turns out there wasn't much other contamination. The contamination found in phase 2 alone isn't enough to warrant any further action or disclosure to state authorities. The PCE level is below legal action limits. My lender is also okay with it, so I'm thinking of buying this property. I want to remedy the contamination just in case state law about reporting level changes. This person goes into who they use. They use AEI Engineering, a very good firm. This is a very good question. And when you're buying retail or any other land parcels that may historically had some form of business or storage, with particular use is going to be car washes because they use chemicals and they get drained. They're supposed to separately drain it, but sometimes it flows over to soil, other things. Second, dry cleaner. Now there's a lot of green, clean dry cleaners, but in the 70s and 80s, even to the 90s or early 2000s, dry cleaning, like it says, dry cleaning, they don't wet your shirt or your cashmere sweaters. They clean it dry. They use a chemical called puck. It's green, smells funky, but that gets drained out. And that is highly known in California and to the states to contaminate soil, also be cancerous. Again, I'm not a legal advisor. I'm not saying it's cancerous, but certain states categorize it that way. So a lot of the dry cleaners these days don't do it. That's definitely going to have that issue. Or if it's going to be petroleum station, gas station, or if they used to store oils, or it was like a shipping place for petroleum stuff, or even like cooking oils to other chemicals, such as like AutoZone uses like the oil for your cars, and they have to store it, throw it away. All those areas that may have those business would have some form of contamination. So this is why it's so important. And I know for the due diligence costs, people want to minimize costs as much as possible. It's imperative that you set aside some due diligence inspection costs, such as property condition reports in phase 1, which will cost you about $5,000 or so for both reports. And that will kind of give you the initial report to see if there was any concern. If there was concern, they call it PCE, which is going to be certain type of vapor and materials. But in the reports of phase 1, we call it ESA1, environmental assessment, or phase 1, interchangeable. They're going to have something called REC, recommendation, environmental issues. And once it's elevated, they will recommend you do something called a phase 2, which is going to be the soil testing and air sample testing. Those are going to be a lot more costly, ranges from $10,000 to $30,000 to do so. And phase 3 inspection is, I don't know, most people are not going to get into that because the cost to remediate that and do it is significant. And if you found something like that, does it really meet your return profile to do that? So I'm just going to focus on phase 1 and 2. So phase 1 is not invasive. Phase 2 is invasive. So once you find that soil contamination, you'll find out the elevated levels. Is it 2 inches on the surface? Is it 5 feet under it? The deeper it goes, the remediation cost goes up because you have to remove those contaminated soils. Other issues that comes with these are groundwater contamination. So in certain states that have well water, or if there's every state, because if it's like California, we have groundwater that's significantly below the ground. If the soil is contaminated, those chemicals falls into those groundwater and it's going to be non-viable. So you have to do long duration with the state to monitor that. And also because of that, you may have a restriction on the particular use of that property. We call it special warranty deeds, where if you have that higher elevated contamination, the use might be restrictive. As an example, you may not be able to put a hospital or childcare or school or a multifamily, but they may allow industrial, logistics, or manufacturing or certain retails, right? So you have to understand that, because if you get a property without doing proper due diligence and you have a contamination level, it's going to really impair your business thesis on that investment, or it'll be cost prohibitive for you to do anything with it. So this individual saying is that the levels are not elevated. I'm going to use that. And if you purchased it and your lender has no issue with it, it shouldn't be that much of an issue. If the lender and you refinance that and the new lender is going to have you do reports again, and they might see that and they may go, well, we have an issue with it because we don't like to take any risk. Then at that point, you might have to get something called the environmental environmental insurance to cover any potential liability that may happen today, in the past, or in the future to protect the lender. So that might also impair your ability to refinance that as well too. From a use perspective, it's not elevated. Yes, you don't have to disclose it. Then that's going to be a business decision if you inform your tenants or not. Some landlords, institutional, will still disclose it to the potential user saying, we have soil contamination is not elevated by the rules and regulation, by the standards legally. However, we would like to disclose to you and acknowledge that you understand these issues so that you can't come back and sue us. That's the only reason to do it. Not to be nice people. It's just like, I don't want to get sued later, so I'm going to disclose it for you. So that's a lot of institutional will do that. A lot of mom and pop lifestyle ownership wouldn't even know if they have that, right? Because they wouldn't even do phase 1s or 2 sometimes. So if a tenant that's malicious intent found out later they have that, they may come and sue you and you're going to have liability with that. So always be cautious. If I was you, I would still disclose it. And that's what I'll do. And if you want to remediate, look at the cost of remediation, because if it's a really top level soil, it might be feasible, but if that goes 2, 3, 4, 5 feet deep, it really may not be feasible for you to do that remediation. So I'll look at different types of remediation as a vapor layer. So if you're developing, instead of remediating the soil, they will actually put on this vapor, which will impact this chemical vapor from coming up from the soil into the building. And you could have engineers and also consultants do that as you build that building or that property. And even then, you probably want to disclose to your tenants just to be safe. So that's how I will approach it. But if this property is like $500,000, you're going to drop in $2 million. That's what it is. It might be cost prohibitive. But if I'm buying something that's $24 million and if I'm going to pour in $85 million in to build something, yes, I'll take those precautions before I go shovel to the ground. And I hope that information was helpful for you. If you found this content helpful, please like, subscribe, and follow. Thank you very much.